Elon Musk is pumping the brakes on his $44 billion deal to buy Twitter, citing a lack of information provided to properly assess the number of fake accounts on the platform. Now, Twitter says it is committed to closing the transaction and plans to pursue legal action. Joining us now to discuss is Technalysis Research President and Chief Analyst Bob O'Donnell. Okay, Bob, you largely expected this. Many people actually expected this as well. But in terms of what comes next, it seems that shareholders, they're going to fight for this deal. And so what do you expect the Delaware courts to now move forward with? And what is Musk going to have to prove versus Twitter going to have to prove?
Well, yeah, obviously the shareholders are going to go after it because this was a fantastic deal for them. And clearly it's fallen apart. I mean, look, ultimately the problem is you've got a man who makes emotional decisions about a lot of things, apparently, in his life, and then he has to deal with the consequences. And that's clearly what happened here. In terms of what the court's going to do, it's hard to say. I mean, there's no question that he made a commitment that seems legally binding, and something is going to have to happen. If he pays that $1 billion, then he pays the $1 billion. For him, it's not, frankly, that big of a deal. For shareholders, for Twitter, on the other hand, of course, it's a huge deal because not only is it a financial blow, but it is a bit of an emotional blow, certainly in a sense to them, because the value of the platform all of a sudden gets derided even further than it unfortunately already has. And he was seen as potentially being some sort of savior for the platform. And there were all kinds of elements going on here. And so it's a big problem sort of from a psychological perspective. And, I think it's going to end up being a very ugly court fight, as a lot of people suspect, because obviously the Twitter shareholders and the existing Twitter board is going to fight super hard to get it. Musk clearly is not going to be fighting very hard to get out of it. And a lot of messy things are going to come out. I mean, things like, monthly active user numbers, all these things have been debated in social media for years and years. And maybe we'll see even more of the sort of the dirty laundry that goes on in terms of how those numbers are created. I mean, the fact that we're talking about a million accounts every day have to be deleted sort of speaks to it. And by the way, that's not unique to Twitter. Those problems happen on social media in general. It's the state of where we are, unfortunately. So all of those things kind of come to a head when it comes to this deal and this trial. So it's going to be a very interesting soap opera to watch. That's for sure.
Hey, Bob, it's Julie here. It's good to see you. I was looking at Twitter's revenue growth this morning, and we have definitely seen after a pandemic bounce in that revenue that it has come back down. And, this is obviously not really a growth company in the sense that, social media was once seen. Is that, you sort of just spoke to it, but if you could give us a little more detail, is that the fault of Elon Musk? In other words, it was sort of bumping along before this whole thing, but it wasn't seen as anything spectacular. But right. Has he torpedoed its prospects in a real way?
I think that's a serious question that a lot of people have. And I think there's a very real possibility. I mean, look, we've all seen, for the people who are on Twitter, there are some people whose lives are built around Twitter, and that's literally everything practically that they do there, their incomes and everything else. So there's a very dedicated, strong group of followers and believers. And then there's a lot of other folks who are like, yeah, whatever. And the thought that Musk was going to come in and that's going to bring excitement and new capabilities and new other things to the platform all of a sudden did give rise to, hey, you know what? Maybe they can turn these things around. With him walking away, that's what I was saying. It's a huge psychological blow because it's like, oh, well, maybe not after all. And it just continues to bump along as it is, which makes it not a particularly great investment and frankly raises questions long term about the platform.
Bob, isn't this great news for the folks over at Meta and Snap, even TikTok? I mean, you're essentially watching a competitor drown in real time.
Well, you could certainly make that point, Brian. I mean, that's obviously, I think a number of people are going to see that in the short term. It does raise questions longer term about how any of these platforms, other than one or two, can really do particularly well from a financial perspective. But yes, absolutely. I think you're going to see a lot of people, the sharks swimming around as these follies continue. So on the one hand, you're going to see Twitter want to fight to get what they can. On the other hand, they don't want to drag this out too long because if they do, I think you'll see people get even more concerned and even more of the sharks circling and making more aggressive efforts to do what they can to take whatever audience Twitter has and move them to their platforms or take advantage of whatever things they have. So it is a very real concern, and it's going to be very interesting to see.
But Twitter has already pulled back some of its own features that it implemented. Fleets, that fleeted pretty fast away from the platform. We're continuing to track Spaces to see where that might be monetizable in the future. But when it comes down to engagement and seeing monetizable daily active users, what is this company going to have to do to continue to see that type of engagement, or what type of spending might that even really entail to roll that out on the platform?
Well, I think what we've seen over time is there's this realization that when it comes to Twitter, it's never going to be a particularly huge audience, but the thought is, it's an influential, important audience. Therefore, the value of reaching that audience is higher than it would be on other platforms, right? I mean, if we think about the amount of money that people spend who have regular Twitter users versus the amount that people spend who are, there are kids that are on Instagram or what have you. That's about the only argument you can really make sort of from a longer term perspective. And I'm not sure how well that's worked, because I think that's been tried up till now and it hasn't really dramatically changed it. So it's a good question. Again, we're seeing a lot of challenges with social media. It's become this incredibly influential thing in the world, but it's also created an incredible amount of divisiveness and anger, and all of these things are going to play themselves out with this trial. And like I said, I think it's going to bring focus on that whole notion of daily active users and monthly active users, things that have been kind of questionable, I think, and from a measurement perspective for a very long time across all of these platforms. And that may have a blowback on the industry as a whole as advertisers start to see what the reality is versus what they've been told.
Yeah, and it's already under fire because of Apple changes and everything else going on. Bob O'Donnell, it's good to see you. Technalysis Research President and Chief Analyst. Appreciate it.
Stark warning from the head of the International Energy Agency. He says we may not have seen the worst of the global energy supply squeeze. Joining us now is Wells Fargo's senior equity research analyst, Roger Reed. Roger, good to see you. Some form of calm has returned to the oil markets, hovering around $100 a barrel. But what is likely if we get a supply disruption this summer?
Well, I mean, you've seen some supply disruptions, obviously, or fears of them, right? I mean, sanctions on Russia, outages recently in Libya, and then that's been counteracted a little bit with, lockdowns in China kind of off and on, and then questions about whether or not high prices are doing what they're supposed to do, which is push back a little on demand, right? So even here in the U.S. with gasoline, the run to $5, I can't say that we actually have seen it, but there's reason to believe that, the push to $5 on gasoline did have a little bit of a demand pushback on consumers.
Okay, and so for some of the larger purchases as well, I mean, you think about airlines that have also had to make fuel accommodations that are seeing higher prices, as we had seen in American's kind of preliminary results that they had put out. How much longer will this also need to be factored into fares that consumers are weathering through?
Yeah, I mean, if you take our forecast, we look at it and say, we think prices are going to moderate a little bit because you are going to get some supply growth out there in various parts of the world, including North America. You're also going to see demand growth rates decelerate as we come away from the COVID recovery, right? So we've had incredible demand growth since really the end of the first wave of lockdowns. And so kind of more normalization in the market should allow oil to find a little lower home than maybe the 125 range that we have forecast in the very near term. But you're going to have to balance that against the fact that we put the SPR releases out in the market. Those are going to end roughly, mid-November timeframe. So 1 million plus barrels comes out as maybe we get a supply increase of that. So I would think prices stay elevated relative to, prior periods, and not so much that we're going to get a collapse in prices just because things normalize a little bit.
Roger, it's Julie here. I know back on June 20th, you guys cut your WTI forecast for this year to just under $109 a barrel, 108.67 at the time. And indeed, we've seen oil prices pull back since you guys did that. Going out to 2023 and 2024, though, you're looking for more deterioration in prices to $85 for next year, $70 the following year. What we heard from OPEC and the IEA today seemed to indicate they don't see any big significant change for maybe the foreseeable future. So do you think that we are actually going to see things more elevated for longer than you had anticipated?
You're being rough on me. You're making me live with the oil price forecast. I think a lot of it is, and here's one of the reasons we cut that oil price forecast. So in the second quarter, we had anticipated $125 for oil, for Brent, a little less for WTI. But what we got was significantly higher crack spreads. So the price that consumers were paying was in excess, if you just put it in oil terms in a normal refining environment, was more like $135 crude. You could even make a case that it got as high as $150 at its extremer levels. So we actually, from what consumers felt, more or less right. From what you actually saw in terms of the posted price of crude, we were a little too bullish on the near-term crude price. So there are a lot of pieces to it, but I guess what we look at is, what they always talk about in this business is nothing cures high prices like high prices, nothing cures low prices like low prices. So, some moderation from where we are at what we would consider an elevated level, right? Going back even as far as 2014, lower seem more likely than higher, but a forecast is a forecast. Pretty much the moment we make it, you can start picking holes in it.
Roger, so you have, in terms of stocks, so you have overweight ratings on Exxon and Chevron, but you're underweight, I believe, in Occidental. Why is that the case?
So for us, a lot of it is balance sheet driven and cash returns to shareholders driven. So Oxy, owing back to the transaction they did buying Anadarko in 2019, took on a substantial level of debt. And credit to the company, they've reduced a lot of that debt. But compared to Exxon and Chevron, you're talking about a gross level and a relative level of debt, versus production metrics, cash flow, et cetera, that is still much higher at Oxy. So as we think about, if prices exceed what we think they're going to do, or even if they're on our forecast, the cash returns to shareholders are just going to be much more compelling at Exxon and Chevron than at a company like Oxy.
All right. Well, Warren Buffett certainly would have something to say about Oxy on that front. We do know continuing to increase his stake. Roger Reed, who is the Wells Fargo senior equity research analyst, Roger, appreciate the time here this morning.
Thank you, guys.
Making the switch by flipping a switch. A recent survey by AAA has found that a quarter of American drivers plan to go electric when it comes to picking their next car. Many have already made the switch, according to new numbers from Cox Automotive's Kelley Blue Book. Compared to Q2 of last year, sales of EVs have jumped 66.4%, while sales of all electric-powered cars jumped a record 12.9%. Let's bring in Kelley Blue Book executive editor Brian Moody, along with our senior autos correspondent Praz Subramanian with us here at the desk. So these numbers are certainly not surprising when you look at sort of the cost-benefit right now with gas prices so high. My question to you is the supply there to meet the kind of demand we're seeing?
There is, and there will continue to be. There are more electric cars for sale now than there ever have been before, and that will continue to increase as time goes by.
Hey, Brian, this is Praz here. I'm kind of curious about what you thought about some of the survey data talking about how people are concerned about fuel prices and high prices at the pump, but we're seeing actually sales of hybrids and plug-in hybrids actually down. Is that also more of a supply concern, or is it more of like what I think is they're not so popular as a desirable product?
So I think that's an education thing. It's an interesting point that you took that from the data. I saw the same thing and I thought it was curious, but I think it's a little bit of an education thing, because plug-in hybrids specifically, for most people, will function like an electric car most of the time, and they're also less expensive, and they don't present any issues if you're going on a long road trip. So, of course, electric cars get all the headlines, but plug-in hybrids may be a great solution for just the average consumer, let's say.
Yeah, which has kind of been the bet for companies like Toyota, right? Who've long said that's kind of the transitional car
Exactly.
that's necessary. When we talked about mass adoption, I mean, the issue has always been having the infrastructure follow as well. When you see where these EVs are being sold right now, are we still talking about the major cities, those that have the infrastructure in place? Or are you starting to see a bit more of a diversification?
Well, here's what we're seeing, and I think that this one particular data point tells you a lot. For example, we know that about 80% of electric vehicle owners charge their car up at home. So what does that tell you? That tells you a few things. A, that you can afford a home, or that you can afford a way to modify your home to charge it up, or that you live in a place that's safe enough to plug it in without someone messing with your plug and all that kind of stuff. So I think there's a lot of growing to do with regard to the infrastructure. It's getting better. You definitely can do it. I think one of the things that's telling in this is that maybe Tesla was really onto something by developing their own charging network, something that maybe we didn't appreciate years ago, but all of a sudden it seems like a really smart move.
Well, Brian, let's talk about Tesla, though, because that hasn't necessarily helped them hold on to the market share that they have, because there's so many other options now from Audi, BMW, Lexus, so many other car manufacturers. What are you seeing in terms of their market share declining, and is that trend going to continue?
I think a couple of things with regard to Tesla. It's going to continue to decline somewhat as their overall share of EVs, because more players are going to come into the market and more people will consider those cars. But think of this. Tesla is the dominant player in the U.S., not just in electric cars right now, but in luxury cars. That means they're outpacing well-known brands like BMW. So that's one thing to consider. I also think there may be a slight dip in Tesla's market share as those other cars come on. But once the average consumer realizes, oh, they have their own charging network and they charge up super fast, I think it's going to dip and then it's going to go back up past beyond what it was to begin with. That's a smart move that I don't think the average person quite understands how convenient it is to have the supercharging network at your disposal.
So, Brian, your data shows about 5.5% of the market right now is EVs, according to Q2 data. You know, we referenced a study today about how 25% of Americans say they will buy an EV when their next car purchase comes up. When do you think we'll get to that point in a few years' time where we'll actually see that 25% of the market being pure EVs?
So here's what I think will happen. So you're exactly right. One thing that we're seeing is consideration is up. So for example, people are saying, I'm open to the idea of getting an electric car or a plug-in hybrid, but that doesn't always translate into sales. And I think what happens is people look at the price and they say, okay, maybe next time. So as soon as the price starts to get a little bit more in line with what you would pay for the average car today, then I think you'll see that take off. Because right now, the average price of an electric car, let's just say for June, was over $66,000. That's quite a bit of money when you think about where we are today, even with gas prices. Remember, factor everything in with your car purchase, not just the gas, the depreciation, the insurance, the cost of purchasing it. Those things have to come down for widespread adoption of electric cars to come. It will come, it's just not going to be tomorrow.
Which is an important point to make, because if you think about maintenance that's required for EVs, I mean, over the course of the car, some would argue it's already cheaper, but that sticker price still isn't there.
Yes.
I mean, does it come down to that more than the gas price itself? You know, gas prices have people thinking about it, but the price has got to be within, $30,000 to $40,000 range instead of the 60, 70 we're talking about today.
That's exactly right. And when you look at only one thing, one parameter, it's short-sighted. It's just like investing. You want to look at the whole picture, not just one tiny box. So yes, you can save money on gas by buying an electric car. If someone gives you an electric car for free, great. You're going to make all kinds of savings by not buying gasoline. But the purchase price and the financing of that, because the price was higher, is going to cost you. But as you said, over the long haul, those electric cars tend to require less maintenance. And as the price comes down, it's going to be attractive. I think one more thing. The average American, if they were to drive an electric car, I think they'd really like it. We're not there yet. The average American probably hasn't spent much time in an electric car. I think they'd like it once they try it, and maybe that will be worth spending a little bit of extra money for.
Well, either way you cut or slice it, more and more Americans getting into EVs. Maybe it's just a supply issue. Kelley Blue Book Executive Editor Brian Moody, as well as Yahoo Finance's Pras Subramanian. Thanks to both of you.
Welcome back to Yahoo Finance. I'm Jennifer Schonberger. Ever since stablecoin Terra and sister token Luna failed, crypto markets have plunged, touching off a series of defaults and failures of crypto lenders and funds, costing investors billions of dollars in losses. That's raising urgency for a regulatory response, just as Europe passed sweeping rules to regulate crypto. So what rules should be put in place to regulate crypto? Joining me now on a Yahoo Finance exclusive is Securities and Exchange Commission, Gary Gensler. Chair Gensler, welcome back to Yahoo Finance. Thank you so much for being here.
Great to be with you, Jennifer.
So it seems like another day, another crypto lender fails. We just saw Celsius file for bankruptcy yesterday. More customers are being frozen out of their accounts and from their assets. How do we stop the situation from happening? Should similar rules that apply to traditional brokerages that protect customers' assets and access to accounts also apply to crypto, or are these merely masquerading as unregulated banks?
Well, in a word, yes. Just think of it this way. You've got a bunch of platforms, crypto lending platforms that had been offering anywhere from 4% yields to 20% yields in an interest rate environment that was generally for short-term deposits less than 1%. You've got to sort of think, if you're an investor, if it's too good to be true, maybe it is. And how is it that that would be possible? And so a lot of risk may well be embedded in that. And we have securities laws. As you said, we have banking laws. But under the securities laws, if you're pooling a bunch of people's assets, we usually call that an investment company. And some of these lending platforms had $500,000 or $2 million or even more members of the public, investors, pulling their assets together, and these platforms offering, as I say, 4, 7, 8, 10, or even 20% returns, sort of too good to be true type of returns.
Chair Gensler, given that you've said that nearly all tokens, with the exception of Bitcoin and perhaps Ethereum, would be classified as securities based on their use cases, how do you feel about applying the disclosure regime under current securities laws for equities to crypto?
So it's really an age-old concept. If you're raising money from the public and the public's anticipating profits based on the efforts of that common enterprise, that's a security. It's kind of a logical thing. And we at the SEC have a disclosure regime, as you said. I've said to the industry, to the lending platforms, to the trading platforms, come in, talk to us. We do have robust authorities from Congress also to use our exemptive authorities that we can tailor investor protection. And on your specific question about the tokens themselves, even tailoring what the disclosures might be, because maybe not all of the disclosures for somebody issuing equity are the same as a crypto token. But I would note we don't have the same disclosures for an asset-backed security that we do for a stock offering. So it's a thoughtful way to sort of tailor things.
So then, just to be clear, Chairman, you would be open to applying the rules that apply to the equity disclosure regime to crypto rather than coming up with a whole new rule book?
No, I'm actually saying something a little different, Jennifer. I think that just as there's a difference between maybe asset-backed securities and an equity offering, there may be differences here as well. And so the public benefits by knowing full and fair disclosure and that somebody's not lying to them. Basic protections. And whether you're buying a crypto token or you're buying a security such as equities or a security such as an asset-backed security, those basic disclosures, because we in America let investors take risk. You get to decide what risk you want to take, but the person raising the money and selling you those financial assets ought to not defraud you, ought to give you the information so you can make your decisions.
Chair Gensler, people are losing a lot of money here. The same protections that apply to traditional asset classes don't really apply to crypto. Curious
Well,
as to
actually, let me say that's because they're non-compliant platforms and token potentially. I can't prejudge any one of them, but we do have robust laws and rules at the Securities and Exchange Commission. My fellow market regulator, the Commodity Futures Trading Commission, does as well. We fortunately have the ability to write rules and use exemptive authority, but the public is not protected largely because of the non-compliance in this space.
right. So to your point, Chair, why haven't you taken more aggressive action in terms of rule writing here? Is it an issue of authority? It seems to be that you feel that a lot of these are classified as securities. So what's really holding you back from acting now, and what can we expect?
Jennifer, I sort of, if I might just not accept the premise, we have rules in place for what it means to be an investment company, like a mutual fund when you put your money in. And what we found earlier this year, and we settled with one lending platform called BlockFi, that they were a non-compliant, unregistered investment company, that they had not yet gone forward and shared their public information with the public. And they had 670,000 investors, $17 billion of crypto. These are all public figures in that filing, in that settlement. And so there is a path forward for these lending companies. We're continuing to work on that settlement as that was publicly announced. And there are paths forward here.
To your point, what can we expect from the SEC in the coming months on the crypto regulatory front? I know that you've been working on a memorandum with the Commodities Futures Trading Commission to essentially come up with a single rule book so that you can both work more closely together, whether a token would be classified as a security or a commodity. How is that going? What can we expect there? What can we expect on the crypto regulatory front from you?
So more broadly, the public right now would benefit from investor protection around these various service providers, if you wish, the exchanges, the lending platforms, and the broker dealers. So we at the SEC are working in each of those three fields, exchanges, lending, and the broker dealers, and talking to industry participants about how to come into compliance or modify some of that compliance. We are also looking at the tokens, the stable coins, so to speak, and the non-stable coins. Separately, we do have discussions with the bank regulators and with our friends and colleagues at the CFTC, because as you said, and I've said publicly, something like Bitcoin is a non-security token, and thus send information over there, collaborate and coordinate as best we can.
You mentioned stable coins. Given the run on Terra, the fact that Tether broke the buck, you had both an algorithmic and a fiat-backed stablecoin both fail. What authority could you use unilaterally at the SEC to protect against runs on stablecoins?
Look, these tokens, so-called stablecoins, are being used as a settlement token inside the lending and trading platforms. What I've said publicly, they're like a poker chip being used inside of the platforms. Those are the current uses, 99+% of the uses inside. And so I think that we look at them and we say they're part of an overall ecosystem that needs protection for the investors, protection against fraud and manipulation. We've also partnered up and working with our other colleagues at the U.S. Department of Treasury and elsewhere, and feel it may be appropriate also for Congress to weigh in to ensure for financial stability. Now, a lot of these tokens also have attributes similar to money market funds. You know, they have taken money from the public and then the public, in the way they use them, they're getting yields or rewards, sometimes it's called, on these stable coins and the like. But we're really focused on trying to ensure for the public's protection in the use of these tokens. And again, the stable coins, there's 2 or 3 of the big ones, were all founded and run by affiliates of crypto exchanges. And I don't think that's any surprise. I mean, it's some of them are multi-use, so maybe multiple casinos you can use the chip, the settlement token, but they're not fundamentally yet used to buy a cup of coffee at Starbucks.
Right. And the time we have left here, Chair, I want to ask you a question actually unrelated to crypto. The Supreme Court just ruled in June limiting the powers of the EPA when it comes to regulating greenhouse gas emissions. Curious what impact, what challenges that might create for the SEC, given the proposed rules to require public companies to disclose climate risks and greenhouse gas emissions.
Jennifer, we put out the proposal and received a lot of public comment. I think well over 4,000 unique public comments. So we're still sorting through those comments. Staff is doing the work. Anything that they might recommend to our commissioners will be with an eye to the law, and certainly all the body of law whenever we move forward, including this recent ruling of the Supreme Court, that we do things based on the economics and based on the law.
Chair Gensler, thank you so much for your insight this morning. So appreciate it. Hope to talk with you again soon.
Thank you, Jennifer.
All right, one bank says a bounce back is not on the horizon for the markets, at least not this year. Bank of America slashed its S&P 500 target to the lowest on Wall Street at 3,600. The bank is citing recession forecasts and a possible Fed pivot as the reasoning for the drop. Joining us to discuss this 900-point cut is Bank of America Senior U.S. Equity Strategist Jill Carey Hall. Jill, happy Friday to you. What prompted you to make this call right now?
So we've been more cautious than many of the strategists on the street. You know, going into the year, we were looking for a down year in equities. So we did reduce our S&P 500 target to 3,600 for year end. That is several percentage points below where we're trading right now. But it's not as bad as the typical decline that you would see in the market during your average recession. So we at BofA are expecting that we're going to be entering into a mild recession starting around right now, and that we could have 5 quarters of negative sequential GDP growth through early next year. But this recession, we would expect, given the lack of excesses in the economy, to be a milder one than many of the recessions historically. So we do expect that the decline in the market wouldn't be as detrimental as some of those that we've seen. We do expect it'll be a volatile backdrop, and this backdrop will be about picking your spots within the market, looking for higher quality stocks, lower risk stocks that have healthy free cash flow. Those are the areas that we think are, well positioned to hold up within the market.
Jill, 5 sequential quarters of negative growth, that's pretty significant. I'm not hearing that out of a lot of other Wall Street firms. What's your maximum downside risk for the S&P 500 if that does come true?
So our base case is that, these 5 sequential quarters of negative GDP growth, the peak to trough decline in GDP is going to be around 1.5%, which is similar to the recession in the early 90s. So one of the milder ones by historical standards. So, we do think that the S&P 500 ends the year at 3,600. Our sort of max, downside case scenario has been 3,000 to 3,200 on the S&P, which would be more consistent with the typical, a little bit over 30% peak to trough move that you usually see within the market as a downside case.
Hey, Jill, it's Julie here. So I guess tonally, what you're saying and kind of the attitude of this downgrade to your target is not different from many others that we've been hearing. So I guess I'm trying to figure out what exactly is different. It sounds like perhaps the duration that you guys are predicting for this recession is a bit different. What else do you think that you're seeing that some of your peers on the street are not? To be clear here, this is the lowest target of the strategist on the street at 3,600.
Yeah, I mean, I think, the consensus, economic outlook hasn't necessarily been forecasting recession yet, but at B of A, we have felt that, at this point, we're likely entering into a recession now. Again, we do think it will be milder by historical standards, and the upside case is that we have a soft landing. We do track a number of other indicators, and obviously all recessions are different, definitions of recessions are different. We track a regime indicator to attempt to figure out where we are in the cycle based on a number of different macro data inputs. That indicator has still been suggesting we're more of in a late cycle backdrop. So again, I think, the upside risk here is that we do have more of a soft landing. I think what else is different is, based on the backdrop that we're in. So I head up small and mid cap strategy at B of A, and we do think that, even though we're forecasting downside to equities, that within the market, a better place to be is small caps than large caps. And so, that's not typically small caps underperform in a recession, which they have so far, but they've actually already been pricing in the recession risk in our view. The decline that we've seen in small caps has been much more comparable to even some of the worst recessions that we've seen. Valuation multiples have come down to prior crisis lows. So we actually think that, based on what's been priced into the equity market at this point, you could see less downside risk from here for smaller stocks than for larger stocks. And I think the nature of this economic backdrop, we found it to, in our view, be a more supportive environment for domestic U.S. small caps, given a lot of the trends we're seeing, higher inflation. Small caps actually outperformed for, during the 1970s, the early 80s, inflationary regimes. And, these stocks are more domestic, given all of the geopolitical risks. We're also, given the coming earnings season, going to be watching corporate commentary closely, because what we've been noticing is that even though management's commentary has been growing weaker and corporates have started to guide down more within the S&P 500, for small caps, guidance has actually been improving in recent months and is much more positive than it's been typically leading into recession. So we'll be watching that closely, but right now we do see small caps as better positioned than larger stocks.
And are there particular areas, subsectors, for example, within small caps that are attractive to you, or are you more looking at them broadly as an asset class?
Well, both. So I think overall, we do think on a relative basis, they look more attractive than large caps. But, certainly there's been a really big focus on quality within the market. And there's a lot of ways to define quality. We could think about earnings stability, stocks and sectors and that have more stable earnings. You could also just look at, companies that are profitable versus non-profitable. And one of the reasons the Russell 2000 small cap index has underperformed so substantially is that, about a third of the index is stocks that are non-earners, stocks that, don't have profits currently. A lot of that has been within, healthcare, biotech. So that's a sector where, within large caps is a defensive sector we've been more favorable on. Whereas within small caps, we do think that sector still looks riskier, given how many stocks are still lower quality, don't have earnings. The S&P 600 small cap index, in contrast, you've seen a really big divergence there in how these two small cap indices have performed. The S&P 600 is a much higher quality index. So, much fewer stocks in that index are non-profitable. And that small cap index has actually been outperforming the large cap indices year to date. So, we would advise focusing on quality, across the board within both small and large caps. Focusing on stocks with healthy free cash flow, which tends to be rewarded in this backdrop. Focusing on dividends. I mean, we're in a total return world. Dividends are, going to matter more than they have been when we were in a backdrop of price returns that were much more elevated. And we do think that, companies that are, able to sustain and raise dividends will be rewarded. And we have seen a reward for companies that have been paying healthy dividends within both small and large caps for much of the last year.
Yeah, and Jill, that's a really good point between the S&P small cap and the Russell 2000, a differentiation that we don't always hear a lot about. Jill Carey Hall, good to see you. Bank of America Senior U.S.
Thanks.
Equity Strategist. Thank you.
There's a lot coming at investors right now, from weak bank earnings to high inflation to rising interest rates. Joining us now for more insights on the road ahead for markets is Henry McVay, KKR balance sheet CIO and head of global macro and asset allocation. Good to see you this morning. It's been an interesting start, Henry, to earnings season, to say the very least. But one of the key takeaways is that margins are starting to come under real pressure. Do you think more margin pressure has been fully priced into markets here?
I think we're going to have more margin pressure. I mean, if you look at the consensus from Wall Street, they're looking for 85% of companies to have rising margins next year. So people are offsides. That's likely not going to happen. You've got rising wages, higher input costs, and ultimately some slowing of unit volume. So our base view at KKR is that for the public markets, you are going to see some margin degradation. You've seen it, also just within the financial services industry, which is where I started my career. You're seeing rising provisions and slower banking fees, and that's obviously caught people's attention.
Henry, you say in your latest note, it's Julie here, you say in your latest note, current market conditions are about as choppy as I have seen it during my career. And I followed your career at Morgan Stanley. You've been at this a long time. So I think that's saying something when you say it's as choppy as you have seen. You also talk about regime change in that note. So it seems like you and some of your other peers across financial services are kind of throwing out the playbook in some ways at this time. How do investors need to be thinking differently right now?
Yeah, you're hitting the nail on the head. So our base view at KKR is that there has been a regime change. We've been saying this for some time. We've been investing behind this. There are a couple of analogies that I would use over my 31-year career, or things we should think about. One was when China built out its fixed investment in the early 2000s. They hoovered up all the oil and commodities that they could find, and you had input costs going up faster than output costs. And that's exactly what we learned this week with the PPI being above the CPI. And so the action item for investors there is to find things with pricing power, right? There are parts of real estate that have that. There are parts of the industrial sector that have that, parts of technology. But if you buy a price maker, you're going to do okay. If you buy a price taker, you're probably going to get hit. The second thing that you referred to, is just earlier in the 1990s when I did start in my career at Morgan Stanley. That's when we had the Fed was last time they were doing 75 basis point increments, and it upset the apple cart in the bond market, and it hurt insurance companies. And so that's another important analogy that we've been focused on. I'd say the good news is that insurance companies were better prepared this time. We also haven't seen the same level of exits where people redeem their policies, and that created some of the consternation back in 1994. But we do think we're going to have a higher resting heart rate for inflation. We don't think it's business as usual, but given what we are doing in our real estate franchise, our infrastructure franchise, the focus on high free cash flow conversion, private equity, we feel pretty good about it. But I do think when Jamie Dimon had made comments about the hurricane. I think he's downgraded his storm forecast, but certainly would target having their inventories up 43% sequentially. That caught our attention, and it corroborated many of the views we've had at KKR for some time.
What also caught my attention, when you talk about looking for companies with pricing power, I look at a company like PepsiCo that reported earlier in the week that seems to still have some pricing power. And yet, as you point to in your note, you think there's actually going to be consumer goods deflation. And you point to something like Target and Walmart and the inventory builds as an example. Do you think we're starting to see that turn already? Or when do you think that is going to really start to, because it doesn't seem like it's happening on the sort of consumer durables or consumer staples side as of yet?
Yeah, look, I mean, people still need to eat. They need to go to work. And so they're going to put gas in their car. They're going to, have food and drink. And so what we're really focused on is there's kind of a matrix where one of the things you focus on is unit volume and the other one is pricing power. And so you try to optimize that. PepsiCo told you that they had both the unit volume right and the pricing. Some companies are going to increase prices too much, and that's going to slow unit volume. But by and large, where we are focused is the consumer durables is an area probably where during the pandemic, people bought more goods than services. our economy in the United States is largely a services economy. So there's a very bullish undertone, which is services is going to rebound. You saw this last week in the jobs report. Professional services is up, travel and leisure, health and wellness, education. Those things are going to do okay. We're not calling for Armageddon. This is not 2007, where you have a massive bank deleveraging or a housing market that's been fueled by speculative mortgages. What we're having is, as I mentioned earlier, it's a regime change where we've got one is too much money went into the system. That's point one, post-pandemic. Point two is we've got geopolitical risk that are creating commodity spikes that are hard to forecast. And the third really is around, we have a supply side shortage of housing. Housing is about a third of CPI. And what you saw from the CPI report is that number is very sticky. And that's why when we look at the Fed's forecast for next year, they've got 2% growth and 2% inflation. We're below the Fed on growth and we're above the Fed on inflation. We'll see where the dust settles, but the data right now is I think, confirming our thesis about this different type of recovery. And that's really our message to our investors, which is this isn't a time to just go to the sidelines and do nothings. Prices are down. There is some opportunity, but it's a different playbook. And I would just encourage people to spend time either reading the note or thinking through what worked the last decade. It was getting long growth. It was getting long investment grade debt. We don't think those are going to be the leadership sectors this time. It's going to be a more diversified portfolio, more upfront yield, more cash flow, and more pricing power across these asset classes.
If the Fed comes out in a few weeks here, Henry, and raises rates by 100 basis points, do you think that serves as a shock to the economy in a bad way?
I'm in the camp of 75. These are big increments. 100 is a big number. Ultimately, it's art, not science. To get what's the Fed trying to do? They're trying to get their interest rate to the neutral rate, to kind of neither have too much inflation or too little, but growth is slowing as we're doing that. So I probably would do another 75 and then keep the option open for 50. Our forecast, unfortunately, is that inflation gets down to only about 7% by year end, and next year it's about 4%. And so there's going to be a delicate balance that the Fed needs to achieve. So, they may do 50, the market, it's kind of going there. I think if we get some other really strong economic reports between now and the end of the month, maybe they could do 100, but that wouldn't be my base case right now.
One of the other areas where you guys are looking is at the energy transition, which I know has been a common theme, a common investing theme that a lot of people are looking at right now. Policy doesn't necessarily seem to be on your side right now. We're just seeing a step back to some of the climate change legislation from Joe Manchin. Is that going to be, though, an obstacle, or do you think that industry is going there anyway?
I think industry, there's a lot embedded in your question.
Yes, sorry.
Very, very, very good. It's a great question. It's hugely important to us. And so I want to spend a little bit of time on it. One is the biggest opportunity for a firm like KKR that employs over 1 million people through its portfolio companies. We own over 200 companies globally, is to move our footprint from brown to green. And that decarbonization effort is probably the most meaningful thing for the environment and for the economy. So that's how you play defense and you make your companies better. And we're certainly committed to that. That's a massive CapEx upgrade spend cycle that's going to take place, right? That's you can count on that. I was just looking at some of the data this morning from Melius Research, and it really confirms that. The second thing is on the forward spend. A couple things to unpack there. We think that's somewhere between a $70 and $80 trillion opportunity over the next couple of decades. A lot of that will come out of Asia. About 2/3 of that spending will come out of Asia. And a lot of it will come in the form of power generation, but also in things around technology. So I do think we're headed there. I think what I would probably push back on is it's going to be a very bumpy journey because you can't have energy transition without energy security. And one thing we've learned from Russia-Ukraine conflict or the war where they've been invading is that it's going to create issues. The second thing is a lot of the renewable inputs are in hard, difficult places in the world. And as you extract them, the costs go up and there are political issues. So I think we're all very bullish about this theme. It's just going to have some puts and takes. And there's also a lot of capital went in that area. And so you just have to really focus. I mean, we have a huge global infrastructure business. We do this across real estate and also across private equity. And I think we're patient, but we're picking our spots. But again, one of the best things to fix the environment is actually the existing companies improving their footprint. And I think you'll see KKR take a leadership role in that part of the business as well.
Well, hopefully we can check in with you on all of that as that's ongoing. Henry McVay, great to get some time with you this morning. KKR balance sheet CIO and head of the global macro and asset allocation team there. Thank you so much, Henry.
Thank you so much for having me. Have a great weekend.
You too. Thanks.